What's up, gang? My name's Brennan. Let's talk stocks. So the other day, I'm just hanging out, scrolling through Instagram, making sure I follow the Brennan Fisher company, and all of a sudden I see a post titled Apple Fundamental Analysis. So I start scrolling through, and the post is talking about what Apple does and their different revenue streams, and then at the end is a discounted cash flow analysis. Now, the creator of this post came to the conclusion that Apple was worth exactly $80.75 per share, based on their different assumptions in the model. So I'm looking at this and I'm like, this is the worst thing I've ever seen. So I feel like, especially recently, more and more people have gotten obsessed with this idea of using a discounted cash flow model to determine this like mythical intrinsic value of a stock. Like, I see people talking about it all over the place on Instagram and on Reddit. People are doing like DCF analysis in YouTube videos. But here's the thing about those DCF models. They don't work. Like, just think about it for a second, right? If the entirety of the stock market could be boiled down to like a few equations or like plugging in some numbers on a spreadsheet, then why isn't everybody doing this, right? If it was as easy as that, everybody would get rich doing this. Like all those other YouTubers who are doing all the DCF analysis and videos, they'd all be like rich beyond their minds. Like, why would they even be doing this? If that was a concept, just that an equation could be used to determine where the stock market's gonna go, then the entire thing would just be quanted away by like these giant Wall Street hedge funds. It just doesn't work. The reason this DCF model and a bunch of other models like it don't work is because they're all based on a bunch of assumptions that nobody could reasonably and reliably predict over and over again. Like, all these assumptions are like consistent free cash flow growth and what are interest rates going to do in the next year or 2 years or 10 years. Nobody could actually tell you this without being completely wrong. Like, there's not a single person on this planet who could honestly tell you any of those things. Now, I did some digging and I found out that this whole idea of using discounted cash flow to calculate the value of a stock goes back to the 1920s when it was pioneered by Ben Graham, of course, because everything on this channel has to go back to Ben Graham. Regardless, the idea started to gain more popularity in the 30s once the Depression hit, and I guess ever since then it's kind of just been ingrained in all of our minds. But here's the thing, after doing some more research on this, I couldn't honestly tell you why anybody still uses it today. Like, for example, the DCF model was only mentioned one time in all 600 pages of The Intelligent Investor. And as a matter of fact, it was actually only mentioned because Ben Graham said that it doesn't even work. Let me repeat that. Ben Graham himself, the one who came up with the DCF analysis as a basis for valuing stocks, he himself said that it doesn't work. Charlie Munger was actually quoted in a Berkshire Hathaway meeting as saying that he couldn't actually give anyone a formula to use for valuing stocks because he doesn't use one and he doesn't believe they work.
If you want a formula, you should go back to graduate school. They'll give you lots of formulas that won't work.
So what does work? Well, it's kind of hard to tell. There have been multiple times in history where people have seemingly found this magic formula that works until it doesn't. Like, for example, there was the dogs of the Dow strategy, there was the Piotrowski S-score strategy, and then Dow theory of the 1930s. All of these things worked for a little bit and they worked for different studies, but as soon as those studies were published, they suddenly no longer work. Hence why we never really hear about any of these formulas anymore. Again, if it's as simple as plugging numbers into a formula, then the edge of the formula would go away because everyone would just be doing it. This is why Benjamin Graham in The Intelligent Investor stressed so much throughout the book that an investor has to be adaptable to new market conditions. So we can kind of look through history to see how different investors did it throughout different market conditions. So like Benjamin Graham, for example, he had switched from using more of a discounted cash flow approach in the 1920s to looking more at companies where the equity was worth more than the stock itself in the 1930s and 40s. Peter Lynch liked to focus on companies that were growing their earnings rapidly in the 1970s. And Warren Buffett discovered in the 1980s that he likes to buy shares in companies of big household names where the stock price has temporarily been beaten down a little bit. But most of all, I like what Charlie Munger said about this when he said that he just mixes all the factors together, and if the gap between price and value is not that attractive, then he just moves on to something else. He then gave the example of Costco and how he bought Costco when it was selling for about 12 times earnings. But he liked the business model of the company and how they use memberships to just charge customers, and he felt that the business was positioned well to just grow over time. He obviously ended up doing really well with that investment. So none of the big investors that we always hear about use any type of formula or financial model or anything like that to determine their investments. Rather, they just buy good businesses that are in a good position to grow over time, and they make sure they're buying them at a price that's cheaper either relative to their competitors or relative to the stock itself historically. And with that, thank you guys so much for watching. Remember to hit the like button, subscribe, follow me on Instagram, all that good stuff, and I'll see you guys in the next one. I would pay you my entire net worth, right? I don't know what I'm talking about. Different investors did it in different market conditions. There we go. Does not what?